Strong day for cyclical stocks, energy, industrials, materials, financials. Jim Leventhal, I feel like you deserve the first word here. You deserve it.
Thanks,
You've
Scott.
taken, look at you, you have a glow around you. You've taken so much heat. It's so much heat. Is this exactly what the Bulls needed?
Yeah. Yes. And I'll add to that, of course, but it really started 2 Fridays ago, Scott, on that labor report that showed that we got a lot of jobs being created. So employment's good. The economy should be hanging in there, but average hourly earnings were easing. And now we see further easing in CPI. You know, what's interesting, Scott, is June's estimate for headline CPI is 3.2%. I'm looking at the Cleveland Fed forecasting, 3.2%. I mean, that's a number like you just say that number. And I know we want to talk about like, hey, there's the core CPI and there's core services X housing, but no, headline CPI, if you're down at 3.2%, I submit to you that the Fed should be taken out of the game. Not that they've done a bad job. That's not what the point is, but they should be done. They should be done. And what that then allows is the strength of the economy, which I and others have been talking about for quite some time, to really shine through and really shine through in those cyclicals, in those industrials, energy and material stocks, and I'll end on this, Scott, those financials, which it's hard to believe. It was 2.5 months ago, Silicon Valley Bank. But have you looked at the regional bank index? I mean, it's really actually doing pretty well here. So the fears of a systemic decline in the banking system seem to be not happening. There's a lot of good things going on.
Steph, market feels like it's said, all right, Fed, you're done. You're out of here. You know, tomorrow they're probably not going to do anything. But the market can't be where it is now without an even bigger picture view of the Fed. And it does appear to be like, okay, we've already factored all this in. We know what you've done. We know what you still may do. And we're good with it.
Yeah, we're up 15% in the S&P 500 year to date, and the long-term total return average is 7. So we've had a really good year. We are pricing in a soft landing at this point. I'm not so sure, looking at these numbers today, that the Fed is done. Certainly the headline number at 4% is great compared to 9.1% a year ago. But the core CPI number is still much too hot and high at 5.3%. And if you look at shelter, which is 40% of the CPI, that was up 8%, right? And I know used car prices, that certainly hurt, and that's going to reverse. So I got that. But shelter is a big piece of it, and it's not cooling down anytime soon. So maybe the Fed, they're going to pause probably tomorrow. Maybe they go in July. Maybe they don't. But I just don't think that they're going to all of a sudden change and pivot and start to ease anytime soon, given the numbers.
Why are you buying cyclical stocks then?
Because we talked about it. I have kind of a balance. I mean, I do have some technology stocks, but I think the cyclicals, I think they offer a great value here. And by the way, I think we can have a soft landing. We're going to slow, but I'm not saying we're not. I'm just saying the Fed is not done. And that's two different things.
Permission to cross-examine the witness, Your Honor.
Oh, boy, here we go.
Proceed.
Oh, God.
Proceed, counselor.
Zillow
Carefully.
rents. Yeah, of course. It's Stephanie. It's me. Of course. We're good. Zillow rents are really declining and leading the shelter component of CPI. I think CPI is very much lagging, and I think others have said that as well.
But new home sales are at levels not seen since last March. So housing is certainly starting to recover.
Good.
And housing leads rents. And so I think you're going to see stabilization in home prices, and rents are going to
There's an air pocket forming in the CPI under rents. There is. And there's also an air pocket in CPI forming under used cars, which is known to be a lagging factor as well. Now, Steph, you and I are on the same side of how we're investing.
I was just thinking, like, you guys are on the same team, but it doesn't sound like it. Like, you're on team rah-rah.
I am on team rah-rah.
I'm realistic.
And Steph doesn't sound like she's on team rah-rah.
I think I'm realistic. I think even if CPI came in with a 3 handle, the Fed is not going to reverse course.
The Fed would be well. It's not about reverse causing. It's about being stopped.
Let's get Sarat in. Let's get Sarat in. Who's more closer to the reality of where we are, Steph or Jim?
I think they're both looking at it 2 different sides, but coming to the same conclusion. That the market today is saying that the Fed is pretty much going to stay where they are, and if they do raise, there'll be one more time, but they're not going to cut because we still need all this data to show that things are really coming down, and we don't have that yet. So they're going to say these are lagging indicators. The economy is still chugging along, and the best case scenarios for all of us, which is why I also am in cyclicals and industrials and materials and financials, is to say we have a slowdown, but it's not a huge slowdown, and it's a soft slowdown, which we can kind of come back from. But if the Fed hints at cutting, it is going to be really bad for the overall market because that
they don't have to hint at cutting, but if the market believes that the Fed is done, and even let's just say tomorrow's nothing, okay, maybe July's a quarter,
right,
but then they're done.